Okay, so now what we want to focus on here is the balance sheet. And I want you to take a look at this balance sheet layout over here. It's going to be a little different from what you did already in the book example because we have some additional line items. So why don't you just take a minute, pause the recording, and set up these additional line items the way that you see them. Here we have marketable security and prepaid expenses in the current assets category, long-term investment in the fixed asset category, and then down here we have accrued expenses and what else? Additional paid-in capital, right? So take a minute and fix those, fix your balance sheet, and come back when you are ready. Okay, and let's start filling it in. Okay, so to fill in this balance sheet such that it balances, okay, let's just go pick up all of our numbers. Now, cash, we're going to have to calculate after we do the cash flow statement. So let's leave that one empty for now, and then we'll just start picking up the values from the assumptions page for all of these items. So our accounts receivable is 402, and our inventory is, prepaid expenses is 0, and inventory is 836. And our total, we can just copy that formula over from the prior one. Plant and equipment, net is here. Okay, accumulated depreciation, we are going to have to pick up also from the income statement, right? Because we're going to have to add this year's depreciation expense to last year's depreciation. So let's go ahead and just go ahead and do that. So it's going to be equal to last year's depreciation plus this year's depreciation expense. And again, net fixed assets, we're just going to copy this formula over because we're lazy. And then the long-term investment balance is also going to be 0 because, again, we're just trying to replicate. What did I do? We're just trying to replicate what we had for the example first. Total assets, we're going to copy the formula over. Accounts payable, we pick up 175. Notes payable was the 225. Accrued expenses, we didn't have anything this year, so we'll say equals nothing. So that gives us our total, our other current liabilities were 140. Total we can copy over. Long-term debt we're going to pick up. So they took on more long-term debt. That means that their total liabilities we can take over, increased. And common stock stayed the same. Pick that up. Additional paid-in capital is 0. And our retained earnings, we also can't calculate yet. Okay, so I'm going to pause this recording for a minute, get my wits about me, and then come back and speak to you again in a moment. Okay, so just to keep things square for you, I'm going to take and highlight these cells that we've left blank, just so that we remember that these are items in the balance sheet that need to be taken care of after we've done the cash flow statement. Our total equity, of course, we can just copy that formula over, and liabilities and equity, we can also copy the formula over. Okay, now, here's something that I always do in balance sheets. Always, 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 always. Okay, I want to do a balance check. So what I'm going to do, and you'll see that my My font is already preset to be different. I've obviously run through this whole spreadsheet to make sure it works before showing you, right? So I always, at the bottom of a spreadsheet, I do a balance check, and it can be as simple or as complicated as you want. But first, let's just subtract our total assets from our total liabilities and equity. Now, we can see that this is not going to balance, and the reason, of course, is because we haven't filled these two items in yet. But if we go over here, do that same formula, it's a difference of 0, right? So they balance. So let's leave that there for now, and go over to the cash flow and fill in that financial statement, and then we'll start with the easy stuff, and then we'll move on to the more challenging stuff. And again, I'm going to pause this for a moment while I get that set up. Okay, so here we are in the cash flow statement. And we want to do this. Remember, the cash flow statement in all cases is entirely calculated. Okay, so let's take a look at how we're going to get this stuff. Now, it's going to come from the income statement and the balance sheet, so we don't need to be looking over here on the assumption page until we get down to the dividends piece. Okay, so let us move over on this side, look at the income statement first, because this is the indirect method, of course, and so we're going to just pick up our net income, which was $14,400 for this year, and we are going to pick up our depreciation expense because we need to add that back to the income for the purpose of cash flow. Now, remembering that when we have asset items, right? When we have asset items that are increasing, that means that that is a reduction in cash flow. So the way that we set up our calculation here for the changes in our asset items is we take the newer and subtract it from the older. So it's 2015 minus 2016. Okay, so change in marketable securities was 0. Now, can we? No, we can't. Okay, the change in accounts receivable, again, right, we have more accounts receivable this year than we did last year. That means it's a negative cash flow. We're waiting for more money. So it's showing up as a negative $50,000, and we can eyeball it and see that we are waiting for more money from our customers. Okay, change in inventories, likewise, we have more inventory this year than we did last year. So that is going to be a negative cash flow as well. We got more money sitting in inventory. Okay, and then our prepaid expense, likewise, we subtract this year's from last year's, even though the difference is going to be 0. Right. So now, right, that was the asset side of things. On the liability side, the logic is the opposite, right? If we have greater liabilities, that means that we've managed to avoid paying cash. So this time, what we do is we subtract last year's liability items from this year's. So it's 2016 minus 2015. So we have more accounts payable this year than we did last year. That means we have more money in our pocket that we haven't paid our bills yet, basically. And changes in accrued expenses. Now, you'll notice, right, you might be coming along here and thinking, well, wait a minute, where's notes payable? Remember, notes payable is a financing activity. It shows up down here, right? So the only other thing we have up here is a change in our current liabilities. And again, it goes this year minus last year. So we have $4,000 more in accrued liabilities, in other current liabilities. And so our total cash flow from operations, we're going to put this over in column C. and it's the sum of all of these, right? So from our operations, because we are waiting for more money from our customers and we have a lot more inventory, we actually had a negative $73,000 cash flow. Okay. Now we're going to look at our cash flows from investing, and just like when we were looking at assets above, right, if we have an increase in an asset from one year to the next, that means it's a negative cash flow, right? We had more accounts receivable this year. That means that we are waiting for more money from our customers, so that's a negative cash flow. Likewise with our plant and equipment, right? If we have more this year, which we do, it's going to be a negative cash flow. So we subtract we subtract this year's from last year's. Where'd I go? There we go. So negative $36,000 in cash flow from an increase in plant and equipment. And in our long-term investments, of course, it's going to be the same calculation, but it's going to be 0. Okay. So our total cash flows from investing, again, we're going to put that over here. Pick up those two. All right, so we had a negative $73,000 in operating cash flow, and we had a negative $36,000 in investing cash flow. And now finally, with our financing cash flows, the logic is opposite, right? If we have more notes payable this year than we did last year, that means that we have got more cash in our hands, right? So we are going to subtract column C, last year's, from this year's. So let's pick up our change in notes payable. So it's B minus C. And the change in our long-term debt is also B minus C, this year's minus last year's. So we had $100,000 in negative cash flow when we financed it through basically taking on debt, right? Did our common stock change? No, but let's do it anyways. So C minus B. B minus C, I'm sorry, and our change in additional paid in cash capital also. Okay, so now we're going to come to the payoff of our switch that we set up on the other page, right? So when we were making our assumptions here, we had set up this choice here so that we would always have either corporation or partnership showing in this cell, right? Or, I'm sorry, proprietorship, not partnership. So always corporation or proprietorship. We did not, however, calculate what our actual cash flow was. So I believe we had 500,000 shares outstanding at 10 cents a share. And then let's just say that the owner withdrew, or that we're going to put 20,000 in here, right? So now you can't have both. It's going to be either an owner's withdrawal for a proprietorship, or it's going to be a corporate outflow. So let's set up a logical statement over here on the cash flow that will pick up one of these if, depending on what the value is in this cell here, right? So we want to say if this cell here says corporation, and remember, when we indicate a text string, we have to use the quotation marks. Right, so that's our first, that's our logical test. Then, if it's corporation, then the amount of cash flow, first of all, it's going to be negative. And it's going to be the amount of cash flow is going to be the number of shares times the dividends per share. Otherwise, we're going to pick up the owner's withdrawal. So let's see if it works. Okay, we've got a negative $50,000 here, and I tell you, I know that I already made a mistake. All right, so let's change this to proprietorship. Okay, and it picked up a $20,000 positive cash flow. I need to change that formula to pick up the negative of $20,000 because that was a withdrawal, right? So it's, if I say proprietorship, it gives me a negative 20,000. If I say corporation, it gives me a negative 50,000. Isn't that cool? All right, so now our total cash flows from financing, just as above. So sum of all these. So positive 76. So our net change in cash balance was a negative 73 and negative 36 and positive 76. So we had a negative cash flow of $33,000. Okay, I think I'm going to go ahead and end the recording there, and then in the next recording we are going to come back and finish the balance sheet. Okay, so we're going to hit stop.